You all have seen this right here. There's a couple of ladies that they talk about the favorite, these two right here, Vaia and Sylvia. And they talk about what their favorite types of trades. You know, they've been to a couple of seminars. And they said, we asked them, what's your favorite thing to do? And it's this right here, a home run trade. The problem is with the home run trade, it doesn't happen very often. So that's the downside. The upside is when you get a signal, since 1990, it's never been wrong. We've always made money. Now that's pretty good. What we're looking for is a situation where people are absolutely panic-stricken. Remember earlier, or yesterday, I was talking about how you always need to be worried about when the public is too optimistic, that's bad. Well, conversely, when they're too pessimistic, that's good. And we're looking for examples of extreme pessimism. It's based entirely on the level of pessimism in the market. That's it. So it's entirely based on sentiment. Well, why would sentiment accurately forecast the direction of the overall market? And I just want you to think about this. You have a stock. It's at 25, and they're earning a penny a share. Stock, a year later, the stock's at 50, so the stock price is doubled. But now the company's making $4 a share. So earnings have gone from a penny to $4. That's just an astronomical increase in earnings, but only a doubling of the stock price. Everybody follow that? They come in at $4. But if the expectation, the analyst expectations were an average of 410, what do you think would happen to the stock? It would go down, wouldn't it? Because they fell short of what? Expectations. It gets even sillier. The expectations are 410, but the company actually, the earnings are 420. So they're above expectations. But the whisper number, you ever hear the whisper number? The whisper number was 425. What happens to the stock? It goes down. So they beat expectations, but they didn't meet the whisper number. Now, it's gotten even more ridiculous. The expectations are 410. The whisper number is 425. They come in at 450. Blowout earnings, right? Wonderful news. But then they have the conference call. And they say, we had a great quarter, but our outlook going forward is questionable. What happens to the stock? It gets crushed because the outlook, management's expectations are, the management is saying, Wall Street, your expectations are too optimistic. You need to dial them down. Everybody follow that? It's all expectations. Even though the earnings were up, what is that, 4,000%? The stock still gets crushed. Because the expectations weren't met. What this means is that if expectations matter as much or more than anything else, over the short term. It's kind of like the 6-number system, where earnings mattered over the long term, but over the short term, it was speculation. It was the expectations that caused the short-term gyrations. Well, that's what we're talking about. If you can get a good indication of the expectations, you have an edge, and that's what sentiment indicators give us. When we use a sentiment indicator, any sentiment indicator, it's not enough for there to be 55% bulls, 45% bears. I mean, you want it lopsided. You basically want people's price discipline to break down. You want people, you know you've reached an extreme when somebody buys a company for $500 a share and they have no possibility of earnings for 10 years. That's an extreme. And you know, we all know it. People aren't, the second bullet point there, people aren't just bullish, they have to be in a buyer's panic. They're so optimistic that they'll do anything to acquire stocks, no matter what the price. And that's the key underlying factor, no matter what the price. It isn't enough for bearishness to be substantial. There has to be total panic. And people want to dump stocks no matter what the price. When they want to dump stocks no matter what the price, I want to buy it. Everybody follow that? When they want to buy stocks no matter what the price, I want to sell it to them. These are the indicators that I look at in its entirety. We're going to look at the top two, the spike in implied volatility and the total put-call ratio. We're going to look at them in combination. I get the implied volatility data from CBOE.com. The ticker symbol is the VXO. Let's see if we can find it. It is right here. And it's currently at 1460. It also gives us a put-call ratio, and we're going to talk about that later. See the put-call ratio right there? So this is where I get the data. Now, once I've got the data, what do I do with it? I use I do it in Excel, but there's a charting program that allows you to do this too. Just bring up Metastock. This is a graph of the VXO. Right now it's right around here, 1460. And if I want to create those Bollinger Bands around it, a Bollinger Band is a technical indicator created by a guy named John Bollinger, and it creates a standard deviation around a moving average. And in this particular instance, it's we're going to use 2.576 standard deviations and 253 trading days, which is 1 year. And there you have it. The reason, and the numbers are on the subsequent page in your manual, page 117. basically what this is telling us, because remember standard deviation, we talked about that yesterday. One standard deviation is about 67%, two standard deviations is 95, 2.576 is 99%. So if you look at these spikes above the top line, the reason we use a Bollinger Band is when the indicator, the volatility index, is above that top red band, it means that the index is in the top 1% of all readings over the past year. That's what it means. So we're looking for an extreme high in implied volatility. Now the question is, why? What does high volatility tell us? Well, think about what implied volatility is. We talked about it yesterday. Implied volatility is the volatility that you would put into the model in order to get the fair value, the value calculated equal to the price. So the higher the price, the higher the implied volatility. Everybody follow that? The higher the option price, the higher the volatility. So that's what we know about volatility.